The S&P 500 is again hitting new all-time highs. The 2025 bull market continues with green pretty much everywhere we look. And as these companies continue to grow earnings and continue to grow free cash flow, we see more and more dividend growth stocks increasing the amount they pay out in dividends. So in this video, we'll be looking at 4 different dividend stocks that just recently announced dividend increases, and I expect more companies to announce dividend hikes over the next few weeks. And the first stock we'll be looking at today is going to be none other than McDonald's. McDonald's just announced a 5% dividend increase, and if we look at McDonald's over the last year, they're somewhat flat. They're up about 3.35%, and year to date up about 5.83%. Now, if we look at this company from a dividend perspective, and you can see all this data will automatically load in, and like always, if you'd like to download any of these spreadsheets and get access to the ticker data add-on in Google Sheets, it allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, McDonald's is currently yielding about 2.3% after the dividend hike, maybe closer to around 2.4% on a forward-looking basis, and they do have a pretty solid history of increasing the amount they pay out in dividends over time. That 10-year dividend CAGR is close to about 7.5%, and the 5-year close to around 7%. But that does mean that this most recent dividend hike was a little bit lower than we've historically been seeing. What are some reasons that that might be the case? Well, for one, the free cash flow growth over the last few years has been slower. The 10 year is at 5% and the 5-year is at about 3%. Now, there's a couple of different things we have to keep in mind. Over the long term, a company cannot increase its dividend faster than the rate they're growing free cash flow. And if they do, then as a result, the free cash flow payout ratio will continue to grow over time. And we can see right now the free cash flow payout ratio is sitting at about 73%. So the company is using the majority of their free cash flow to pay out dividends. Now, that's not always a red flag. That's sometimes more typical for companies like McDonald's, who are a little bit more on the mature end. In fact, if we go ahead and jump over to our profitability sheet, let's just take a look at McDonald's. What we can see with McDonald's is the 5-year revenue CAGR is about 4%. Now, if we look at revenue versus cost of revenue, it's a really interesting chart. And at the same time, we can see the gross profit ratio chart is quite interesting as well. What's the reason these charts look the way they do? Why has revenue been declining until 2020 and then it started growing, and why has the gross profit ratio been growing at such a high rate? Well, over the last decade, we've seen a fundamental shift in McDonald's business model. Essentially, what's been happening is McDonald's has been moving toward and now essentially operates a business model where the vast majority of its restaurants are franchised. So what exactly does this mean for McDonald's? Well, we can see here. First, keep in mind, this is an image from the end of 2022, but it's a great representation of how McDonald's actually generates revenue. Historically speaking, they've had 4 different business models. They had the conventional license, where essentially McDonald's would provide the building and the real estate, and as a result, they would collect rent on that property as well as royalties. So that's why some people say they're somewhat of a real estate business. They also had developmental licenses, where McDonald's would pretty much do nothing. They wouldn't provide any equipment, building, or real estate, but they would still collect some royalties. Then with some of their foreign affiliated restaurants, it was somewhat similar, but they collected royalties and equity and earnings. And then a very small percentage of the restaurants were pretty much completely investment by McDonald's, and they collected all operating profits. But because they've been shifting towards a business model where the majority of their restaurants are becoming franchised, they're collecting a lot more fee income, royalties, and rent. Which means if we look at the fundamentals, they're becoming more profitable. They're becoming more capital light. This is why we've seen the gross profit ratio expanding. And really, this is the exact same type of business model that's allowed Domino's Pizza to have phenomenal returns over the last 10, 15, 20 years. So we can see revenue trending in the right direction and profit margins are certainly expanding. Next up, we have a large dividend hike from the insurance company Brown & Brown. The dividend increase was 10%, double digits. You know that's something that I love to see. Now, if we look at Brown & Brown in the last year, they're actually trading right at their 52-week low now. In the last year, down by about 15%, and year to date, down close to 13%. Now, this is a stock that has historically had outperforming market returns over the last decade, was up about 445%. So we'll dig into this a little bit more in just a moment. But if we go ahead and look at these dividend metrics, what you'll see is that the starting dividend yield is relatively low. It's about 0.75%, but they grow the dividend at a high rate, double-digit dividend growth, and the free cash flow payout ratio is incredibly low. They use very little free cash flow to actually pay out dividends, so this is why they grow free cash flow at such a high rate. They're reinvesting heavily back into the business, and you can see the dividends are growing at a high rate as well. Now, I was actually talking about this company over on Dividendology.com just the other day and pointing out how the valuation actually looks quite attractive, but first you certainly have to actually understand the business model. Brown & Brown is not a traditional insurance stock. Instead, they're more of a middleman. Brown & Brown connects customers with the right insurance carriers and earns commissions and fees. So if we look at their two main sources of revenue, we have commissions, which is around 70%. Again, they earn commission every time they place a customer with an insurance carrier. And then we have fees, which is around 30% of revenue. They charge fees directly to customers for specialized services like risk management, employee benefits consulting, or claims administration. So essentially what this does for Brown & Brown is it creates an incredibly capital-light business model, which I absolutely love. We can see double-digit revenue growth, and then earnings/net income is growing at a high rate as well, and the margins look attractive as well also. Now, keep in mind they did just complete their largest acquisition ever, buying Accession Risk Management Group, which was a $9.8 billion cash and stock deal. And for reference, free cash flow for this company last year was about $1 billion. And keep in mind, like I always say, there's 5 ways a company can use free cash flow, and one of those ways is mergers and acquisitions. So this was a very expensive deal for the company, but it also should add around $1.7 billion in revenue for the company. And again, for reference, we can see last year, the company did about $4.7 billion in revenue. So if they can continue to achieve free cash flow growth at around 11%, then fair value is considerably higher than the current valuation that we're seeing for this company. And even if we look at how the company has historically been trading, we can see it's trading about 20% below its historical multiples valuation on a forward-looking basis. Now we come to Waste Connections, who just announced a dividend increase of 11.1%. So another pretty nice dividend hike. But if we look at this stock in the last year, again, compared to the broader market, it's certainly underperformed. In the last year, down 1.2%. Year-to-date, relatively flat, up about 2.39%. So let's go ahead and take a closer look at this company. Again, we can see this is a low yielder, but it's about dividend growth in this case. The yield is a little bit below 1%, but the 10-year dividend CAGR is at about 14.65% and the 5-year at 13%. So the dividend growth history is really a thing of beauty. Look at what can happen in just a 10-year time period. 2014, they're paying out about 32 cents per share, and by 2024, they've more than 3x'd that number. That's the power of dividend growth. When you can achieve double-digit growth for even a decade time period, your yield on cost will grow substantially. And because they're growing free cash flow at a high rate as well, we can see the free cash flow payout ratio is staying in a healthy range even though the dividend has grown dramatically. For example, 2014 free cash flow payout ratio is about 19.38%. 2024, it was about 25.77%. Again, just beautiful dividend metrics really all around. If we quickly glance at this company from a valuation perspective, let's look at how they've historically traded. We can see right now they're trading at what looks like a rich premium because their forward PE ratio is 34.39, trailing 12 months, about 35.22. What's interesting is that's actually below their historic average, about 5 to 10%. Now, high PE ratios can be justified if the company is growing earnings at a high rate. And if we look at earnings estimates over the next few years, they're expecting decent growth in the range of around 7 to even 13%, which in most instances is pretty solid for a company like Waste Connections. So why do they trade at such a premium? Well, when it comes to companies like Waste Connections or even Waste Management, for example, people aren't paying a premium because of how fast they're growing earnings. They're paying the premium because of the predictability of earnings. Those are the two items that will typically lead to companies trading at premium valuations. Investors, yes, they love fast earnings growth, but they also love predictability of earnings growth. When it comes to Waste Management, Waste Connections, these companies have a high level of recurring revenue. As for me, I'm not quite sure I'm willing to pay that much of a premium, but that certainly doesn't mean that the stock can't do well moving forward. And then lastly, we have a stock that I haven't covered on the channel before, but it's a pretty unique case study in this instance. We have Comfort Systems, who just increased their dividend for the 4th time. And this happened just a few months ago. Now, the most recent dividend increase was a hike of about 11.1%, but that does not even begin to tell the whole story. When we look at this stock in the last year, it's up 150%. In the last 5 years, nearly 2,000%, and in the last 10 years, over 3,000%. And if we take a look at the dividend metrics for this stock, what you can see is the dividend yield is incredibly low. It's only 0.2%. 0.2%. Why would anybody buy a stock like that? Obviously, it feels like you're getting essentially paid nothing if you buy a company like this. But as you can see, they've grown the dividend at an incredibly high rate. Now, how does this impact the dividend over different periods of time? Well, Seeking Alpha actually does a pretty good job of visualizing this. If we go over to the dividend tab, click on dividend yield. We don't want to look at the historic yield. Let's look at the yield on cost. Look at this over the last 5 years. Yes, the yield was low if you bought 5 years ago, but because they've grown the dividend at such a high rate, your yield on cost is already above 5%. If we do it over the last 10 years, you can see your yield on cost is close to about 10%. Again, that's the power of dividend growth. Now, what is it that allows a stock like this to grow its dividend at such a high rate and continue to build up its yield on cost? Well, it's simple. It's growing free cash flow at a high rate, like we've already touched on. Free cash flow is the lifeblood of the dividend payments. If a stock is growing free cash flow at a high rate, not only are you going to see massive dividend payments and dividends continue to grow in a lot of instances, you're also going to see a lot of share price appreciation. Share price growth and growing dividends are both a byproduct of free cash flow growing. So again, even though if we look at the valuation for a company like Comfort Systems, it looks relatively high. Look at that forward PE at about 37.11. But again, earnings have been growing and are projected to continue to grow at an incredibly high rate. So there you go. Those are 4 stocks that just recently announced dividend increases. Like always, if you'd like to download any of these spreadsheets and get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.